Alright, so welcome to lesson 6, strategy 5, selling cash secured puts. So we're going back to selling again. So recall in strategy 3, you've learned how to sell call options secured by stock, right? Selling covered call. So in this strategy, we'll be selling put options. But the only difference is we're selling put options without owning the shares in the first place. So we're selling put options with cash to secure those put options. So what's the purpose of doing this? Well, the main purpose in this strategy is because we want to buy a stock. We've not bought it yet, but we want to buy a stock at a discount or even for free eventually. In fact, this is a strategy commonly used by large investors like Warren Buffett. And that's how he buys lots of shares at huge discounts over time. So here's the strategy. So let's imagine that you are a value investor. So you buy shares of a good company as cheap as possible. And you have identified, again, a fundamentally good company that you want to own for the long run. So again, let's look at Coke as an example, because in fact, that's the one that Buffett often uses this strategy on. So you would like to buy 100 shares of Coca-Cola. However, you like to buy it at a discount below the current market price. So let's assume that the current market price of Coke is $47.15, and you're thinking, hey, I like to buy it cheap. I like to buy it at 46. So what could you do? Well, you could wait for it to drop to 46 if you wanted to. You could put a buy limit order at 46 and hope you get filled. You could do that, or you could be smarter than that. What you could do is you could sell the Coke 46 puts and collect the premium while you're waiting for the price to get there. All right. So again, recall, when you buy a put, you have the right to sell the shares, correct? But now you are selling a put. So when you sell the put, you're obligated to buy the shares at the strike price. So by selling the Coke 46 puts, what does it mean? It means you are now obligated to buy the shares at $46, which is what you want to do in the first place, right? So why not sell the 46 puts and collect the premium while you're waiting for the price to reach 46? Now, by checking the option chain, you may notice the premium is 57 cents. And again, one contract is 100 shares, so the total premium that you collect would be $57 in this case. Now, if Coke shares were to fall below the strike price, which is Coke shares were to fall to $46 or below by the expiration date, what happens? Well, you are obligated to buy the shares at $46, right? Less the premium that you have collected. So in other words, you're actually paying less than $46 because you got some premium in the first place, right? And this is what you wanted to do anyway. Now, what if Coke shares do not fall below the strike price? Coke shares from $47, they go to 48, they go to 49, and so what happens? So in that case, the option you sold expires out of the money. It expires worthless, and you get to keep all the premiums as profits. And so what you do next month, you repeat the process again, right? You sell another put option and sell another put option, right? So if the price goes up, your put options expire, you collect premium every single month. If the price comes down and hits below the strike price, you buy the shares at the strike price. So either way, you're pretty happy, right? So again, this is one of those strategies where it's a win-win situation. It doesn't matter what happens. You will always win, okay? Now, so again, look at on the left, that's, again, Coke, the long-term chart is always going up, and you only want to do this on, again, shares you want to own in the first place, right? So you want to buy Coke, it's a good long-term investment. And on the right, you can see the current market price is $47.15. But you think, hey, I think it's going to go down to hit the support level at 46. So I'm not going to buy it at 47. I want to buy it at $46. So what do? You sell the Coke 46 puts and collect premium and wait for the price to get there. So once again, let's take a closer look at the charts and how it works. So once again, you can see this is the chart of Coke, and it's on an uptrend, bouncing off the moving averages. And currently, market price 47.15. And again, you could buy it at that price if you wanted to, but you think, hey, you know what? It's ding-donging, and I think it would retest the support at $46 over here. So I like to buy at 46. I like to get a discount. So again, you sell the Coke 46 puts, which means you sell the put options with a strike price of $46. And again, the premium would be 57 cents in this case, and you're selling puts with 40 days to expiration. So scenario number one, the Coke shares fall below the strike price. So what happens? The price goes all the way down, right, below that 46 strike price by the expiration date. So what happens? Now you are obligated to buy the shares at $46. Now, of course, if the price goes to $44, you are still obligated to buy at $46, right? That's the thing that may not be too good. But again, if you are holding the stock for the long run, you don't really care about it going down a bit more in the short term. So when that happens, you will have to cough up $4,600 of cash in order to buy the share. So again, we call this selling cash secured puts, which means when you sell these put options, you got to have the cash in your account in the first place to be able to buy the shares if you are assigned by the put buyer. Remember, the person who buys the puts has the right to sell the shares to you, and you are obligated to buy the shares. So you got to have $4,600 in your account, ideally, in order to buy the shares. Now, of course, it would be less the 57 premium that you would have collected in the first place by selling the puts. Now, scenario number two, if Coke shares do not fall below the strike price, right? If Coke shares continue going up, what happens? Your put options would expire out of the money, okay? And when they expire, by selling the puts, they expire, you don't have to buy it back. So you keep your premiums as profits, and you keep repeating this process until you eventually get the shares. So either way, you're pretty happy with the outcome. Right, so let's take a look at a case study over here. So let's imagine you want to buy 100 shares of P&G, Procter & Gamble shares, for your portfolio. So looking at the chart, the current price is $91.22. And you think, okay, it's a good company, I like to buy it, but I'd like to get it at a discount. So again, you may say, I like to buy it at $89, right? Or even lower, it's really up to you. So you would like to buy it at a lower price of $89. Again, instead of waiting for it to go to 89 or to put a buy limit order at 89, you decide to be smarter. So you decide to sell one contract of P&G March 89 puts. So assuming that the current month is February, March would be about 30 to 45 days away for the puts to expire, right? So you're selling one contract of puts at the 89 strike price. So that $89 is your strike price. This contract has 43 days to expiration. So question would be, what's the total premium you would collect? So check out the option chain. That's the option chain. Look under puts and look under the strike price 89. There we go. So the bid price would be 137. The ask would be 156. Again, if you like to sell the puts at the market price immediately, you'll be selling at the bid price. All right, selling at the bid. If you would like to bargain, you could always attempt to sell it at the ask and queue up with the other sellers, or you could even sell it at the midpoint. It's up to you, right? So assuming you like to sell it at the market, so you would get $1.37 in premium. So what's the total premium you collect? Well, the answer would be $1.37, 137. And one contract would be 100 shares. So multiply that by 100. The total premium you collect would be $137. Got that? All right, so stock selection. So what stocks do you sell these puts against? Again, only sell puts on fundamentally strong stocks that you want to own in the first place. And you should ideally have the cash in your account to buy the shares should your put options expire in the money and you are assigned the stock. So in the case of P&G, you should have at least 100 shares multiplied by $89, which is your strike price, which is $8,900 of cash set aside to buy the shares if you are assigned the shares. Because you remember, as a put seller, you're obligated to buy the shares. Bear in mind, when you sell the put option, roughly 20% of the stock's value will be blocked from your account's buying power. Remember, when you have an account and you put money in the account, you have, for example, if you open a cash account and if you put 10 grand, your buying power is 10 grand because you can only buy up to 10 grand worth. Now, if you use a margin account, what it means, if you put in 10 grand, the broker will let you buy up to 20 grand. So your buying power is 20 grand. And that's the reason is because for every dollar you have in cash, the broker is willing to lend you another dollar. Right? But of course, it's not free. When they lend you money called margin, they charge you interest on that margin. So that's what buying power means. So again, when you sell a naked put option, which is what you're doing, you're selling the put naked, roughly 20% of the stock's value will be blocked from your account's buying power. So in this case, 20% multiplied by 8,009 would mean 1780 of cash is blocked in your account. Now, what's your entry strategy? First of all, always ensure that the stock you want to buy is on an uptrend. Remember that on a downtrend, it's risky to buy, whether you're buying it outright or you're using this strategy. Because on a downtrend, cheap can get cheaper, low can get lower, and it could go all the way down for quite a number of months or even years. So you want to ensure it's at least on an uptrend. Next, the best time to sell options is when volatility is high. Always remember that. You buy options when IV is low. You sell options when IV is high. IV would be implied volatility. So in this case, you're selling options. So you want to sell the put options ideally when the implied volatility is high. When the IV percentile of the share is above 50, you get the best premium for the options you sell. If IV is low and you're selling options, the premium could be too little for it to be worth your while, right? Again, sell an out of the money put at your ideal strike price, which is usually the price which you want to buy the shares at. You can choose 35 to 40 days to expiration. You can choose options that expire monthly or those that expire quarterly as well. No worries. So again, under puts, look at the strike price, and you can then check out the premium, right? The bid and the ask. So again, when you're selling and you want to sell at the market price, you would sell at the bid. If you like to queue with the other sellers, you could attempt to sell at the ask. Or you could even sell at the center of the bid and ask. We call that the mark price. So what are the different exit scenarios for this strategy? So there are basically two scenarios. The first scenario would be, again, the stock price remains at or above the strike price at expiration. So when that happens, again, your option will expire worthless and you keep the entire premium as profit. And when that happens, consider selling a new put option at a new expiry date and at the new or same strike price and collect premium once again. So keep repeating this process again and again until scenario 2 occurs, right? So what's scenario 2? Scenario 2 happens when the stock price goes down below the strike price at the expiration. So in this case, what happens? You'll be assigned the stock at the strike price, which means now you're obligated to buy the shares at the strike price. So automatically 100 shares will appear in your account, right? You wake up one day and boom, you see 100 shares of P&G, and the cost of the shares will be deducted from the cash in your account. And well, once you own the shares, what can you do? You can then sell covered calls on those shares, right? So again, notice that you don't own the shares in the first place. You sell puts until you own the shares. Once you own the shares, you could sell calls. So, you have a dual way now of generating income for your portfolio. So once again, let's summarize the advantages and risks of this strategy. Advantage of this strategy, you get to buy your stock at a discount or even for free eventually, because as you keep collecting premiums until the share price drops to the price that you buy at, the premiums that you collect could eventually offset the entire cost of the stock. Second thing would be you get paid while waiting for your ideal price to be reached. So you keep collecting premium as profit as long as the stock price remains above your strike price. What are the risks? Well, it's the same risk as you buying the stock outright. There's no additional risk compared to you just buying the shares at a discount. So that's it. It's a pretty cool strategy. And so you can use it to again enhance your returns on your portfolio.